Hi, everybody. Welcome to this MNI Webcast. I'm Pedro da Costa. I'm Senior Fed Correspondent here at MNI, and it's my pleasure to host and moderate this event today, and certainly my pleasure to introduce today's speaker, and that's Kartik Athreya. He's Executive Director and Research Director at the Richmond Fed, and we're here to talk about monetary policy, the economic outlook, and of course, the recovery, we hope, from this long pandemic, this long nightmare that we've all been living through. And of course, some of the social issues surrounding the recovery as well, some of the inequalities that have been brought to light by the pandemic. So welcome, Kartik. It's my pleasure to introduce you. And he's going to start with some brief remarks, and then we'll jump right into the Q&A. So I'll hand it over to you, and we'll get started. Thank you.
Great. Thank you, Pedro. It's a real pleasure to join you today and your guests. Let me definitely keep it a little bit brief in terms of how I see the economy and maybe some thoughts on inflation. And then I do hope that the questions will come in and we can use that to direct the discussion thereafter. If I step back from this right now, and if to the extent that central banking is really the art of which obvious thing one says, let me frame it this way. I think that right now the virus still holds the key. It has held the key for a year now. We've gotten excellent news, however, I would say since the late Q4 period of last year into now. There's no question in my mind that things feel different. Obviously the data that are coming in right now make that a reasonable thing to say. And we're seeing the fruits of what I think we've been waiting for, and this year actually could turn out to be a very, very strong year on the real side, something on the order of 6 to 7% growth, which of course we haven't seen the likes of in a very long time. Now, I frame the events themselves that we're now digging our way out of, especially the most recent vaccine-related news, as really a positive shock to both the supply and demand sides of the economy. On the supply side, I see this as a reduction in really what you could think of as an implicit tax on all production activities that required proximity. That's a way of, I think, taxonomizing what the vaccines really allow us to do now that we couldn't have done just a couple of months ago. The hardest hit sector by far, things involving leisure and hospitality, travel and accommodation and so on, those were, of course, severely constrained until very recently, and they're showing signs of a rebound. And the summer period ahead augurs well for them. On the demand side, the way I think of it is that an entire sector of what I would call communal consumption or social consumption, if you don't like communal, is really starting to come back. It's coming within reach for the first time. People were obviously taking risks at the personal level before, but those risks are much less urgent as we now are getting vaccinated, both because individuals are vaccinated and because the fraction of the population having gotten vaccinated has risen, making any particular encounter less risky than it was before, even if you didn't do anything at the individual level to help yourself. So that's kind of a really nice, benefit of the kind of herd. I don't want to claim herd immunity, but of the kind of properties of vaccinations and viruses. So we're going to hopefully really get a tailwind from that. Well, that leaves let's say, nearly 10 million or so people that are not yet back to employment relative to the pre-pandemic era with something to look forward to. And I think that's fantastic because if you've been looking sectorally at the data, and this may not come as a surprise to the people in this room today, you saw the recovery in many other sectors be, while not complete perhaps, very substantial, whereas, the main sectors of food and accommodation, leisure and hospitality, however you want to categorize it, they basically came back to about 80% of their pre-pandemic level, and then they stayed there. They did not do any further converging. Really now for, I would say, 9 or 10 months, there's been almost no further convergence. And now we're going to start seeing that, I think, change. So this is a wonderful development on the real side of the economy. Okay, so if I've characterized things so far as really having been the benefits that we're likely to see coming out of an event, because we've now figured out a path out of it on the real side, namely the vaccine, you should ask the question, well, how sustainable is this anyway? And I think this is important. I'm not going to claim that I know the answer for sure, but I think that it for the year ahead, 2021 and 2022, I certainly think we're going to see well above historical norms for growth. But I don't think going out 3, 4, 5 years that we're going to see very substantial changes to the growth rate of the economy relative to what we had in the pre-pandemic era. In some sense, the power of the growth that we're going to see, or the level of growth that we're going to see this year and the next year, is essentially telling you, at least telling me, that this is about coming out of something that was very, very abnormal and hence not particularly sustainable over any longer period. So that informs the way I think about inflation risks in the sense that in two ways. One, as we look ahead to the very near term, it seems possible, and it seems probable, in fact, that we will see inflation, measured inflation, the way we would normally look at it through PCE or CPI, to be higher than it has been. This is, in some sense, a very natural artifact of substantial changes in real economic activity meeting relatively short-run constraints, and prices potentially being a mechanism, the mechanism by which to ration the claims that people are making against available resources in the near term. So that wouldn't be surprising. Now, the question I think on everybody's mind is, to what extent is that really to be taken? What's the signal extraction, if you will, to go from movements in inflation that we'll observe, that I'm pretty sure we'll observe this year, into thinking about the future? Here, I think it's important to think about, obviously what the Fed as a policy institution will do. It's not, in my mind, plausible that this change in real activity right now is going to trigger anything like sustained inflation. And I think because for that to happen would require other things, especially on the policy side, to kind of just simply go along with it. And I don't think that's going to happen. And I also don't think it's the case that the real side forces are durable enough to just make that an inevitability, almost irrespective of what the central bank does. So for those reasons, while I'm not sanguine, I am confident that in the ability of the central banking leadership to actually deal with anything that ends up coming down the pike along that dimension. But I also don't think that the pressures on that are likely to be sustained in the way that I think maybe has been discussed. All right, so let me move on from there a little bit to just quickly saying, I think it's useful for me and maybe for everybody to go back to sort of the Fed's longer run goals statement. And there's a passage in there that I thought would be, useful, at least, it is for me, where the committee talks about, in order to anchor longer term inflation expectations at this level, the committee seeks to achieve inflation that averages 2% over time, and therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. So, I think to the extent that we're talking about the inflation ahead, I see it more as real side and plus feature, not bug, if you want to think of it that way. Now, one thing I do want to point out is that to my way of thinking, if policy is effective, monetary policy is effective, this is a very general statement on the real side of an economy, it is because its current position is away from its longer run position. And in this particular instance, if policy is effective on the real side at making sure that economic activity is on track with mandate goals, it is because normalization is expected in the future at some point. And I think the reason to kind of point that out, again, I warned you that I was going to say obvious things today. The reason I think it's important is that think about the alternative case of extreme perma zero, if you will, where there was essentially no chance whatsoever of a normalization. And what would that do? So I'd submit to this group, and happy for your pushback. I do think that it would move inflation expectations fairly quickly down, not up. I think that's basically locking yourself into a lowflation scenario. To think otherwise, in my view, is to say that we've basically found a perpetual motion machine, because it would mean that we were actually shaping really long run real rates. And I don't think that's a tenable position for most central banks to be thinking that they can do. So the promise of normalization eventually is what makes policy relevant. And I think, that's something that hopefully the discussion going forward, I'd happy to hear your questions and thoughts on that. And let me wrap up by just saying we're on the cusp of getting out of a tremendous real side disaster, and a real side rebound is what I'd expect. Inflation is not where the committee has really said that it wants it to be, and the conditions for liftoff simply haven't been met. So staying the course seems like is entirely consistent with the way that the Fed has been talking about policymaking, and so far so good. So with that, Pedro, let me turn it back to you and open it up to questions. Thanks.
Thank you so much, Kartik. And yeah, I really appreciate those remarks, as they help us kind of address the market's concerns at the moment and set the scene for our discussion. So I wanted to ask you, it has taken me by surprise a little bit that the market has become so obsessed with inflation, at least in the way it talks about the balance of risks so quickly, given the output gap, or the expected output gap, given the amount of slack that's still in the economy, given that the unemployment rate, when you factor in the participation rate, is still very, very high. To what do you attribute those concerns, and do they surprise you? Have they surprised you like they did me?
I'll admit to being a little surprised, and in a way, for exactly the set of reasons that you, Pedro, just described. The current real state of the economy, as if it needs repeating, the current real state is not great. Growth prospects look good. Growth is on track. It's likely to be a really good year. But I'll remind everybody about what I just said in the beginning of this, which is we're somewhere around 10 million jobs short of where we started a little over a year ago, at a time when on the real side of the economy, besides the virus, it's very hard, at least for me, to tell a story that something fundamental has happened to the supply capability of the economy, to the demographics of the economy. None of those things have changed. There's a smoking gun, and it is the virus, and it has put people out of work. And now at this point, we ought not to think that we're kind of out of this really significant real side problem. So, I don't have a good answer for why it is that concern has been expressed, at least implicitly through recent movements in bond yields. But I would go back to thinking about the real economy having just a tremendous way to go yet before we can declare anything like victory.
Speaking of that spike in bond yields, as you mentioned, that has been kind of the focus of the market now, and it's even been the focus of the equity market. And I wonder what you make of it, if you think of it as still fairly benign, whether there are any levels that would be kind of warning signals for you, as far as levels that might be working against the Fed's goals and tightening financial conditions in some way. How are you watching that?
Yeah, I think that just if you ran through the way one might think about this, it really, of course, depends on to what you ascribe those movements. I do think that the real forces that have happened, I think sometimes when you hear hoofbeats, you got to think horses, not zebras. And so the thing that I'm drawn to right away is to think about the real side news that we've received. It's been very, very positive. These are things that, in a normal world would push upward pressure on real yields. That part doesn't surprise me particularly. Now, to the extent that there are inflation risks being priced in there, and there is some evidence from, let's say, financial market options, implied risk measures that indicate some parties, not a lot, maybe 20-30%, put some risk on the idea that inflation will actually get substantially higher than where it's been, say 3% or something like that. So I think there is disagreement, and I think there are legitimate reasons for people to wonder in their own heads about like exactly where things are going to go. So that uncertainty is contributing something to this. But I really want to think about the real side forces first and foremost. To me, that's the kind of thing that looks like it's behind, behind this idea that hey, maybe things are going to be better. And just for reference, I mean, if you look back, let's say, it's dangerous to do this by memory, but if you look back a couple of years, I think maybe in mid 2018, I think the 10-year was closer to 300 basis points or something like that. I need to look back at that, but so we're at like $1.75, I think, right now, and unless something has happened in the last 8 minutes. So yeah, real side, I think is my go-to for thinking about recent bond yields, but I will admit that there are some features of risks that are getting priced in, though I'm not personally as worried.
Fair enough. I wanted to ask you a couple of questions about QE, not so much what you're going to, what the Fed's going to do, but just how you're thinking about the policy. The Fed has set out guidance about when to reduce the pace of bond buys, talking about substantial further progress. I was wondering if you could talk a little bit about how you're thinking about that, in what terms, especially given that elevated participation adjusted rate of unemployment, if you will.
Yeah, I mean, I won't, say too much about it, but I will say that I think, I don't know that okay. So first of all, I think the committee in its public utterances has been pretty clear about the ordering of operations, if you will. There's a sense in which the substantial forward progress would then inform the nature of tapering, if any, and then we'd go from there to thinking about rates. I think one thing that I do want to just note, as speaking for myself, is when I see sort of rhetorically, when I think about asset purchases and let's say the tapering of those asset purchases, it seems worth just noting that to the extent that purchases are happening at all, that is adding on the theory that QE matters. It is adding accommodation. It is not to be confused, in my mind, with the removal of accommodation. It's sort of the pace at which accommodation is occurring may be slowed, perhaps. And so there's this sort of distinction between level and slope that I think bears noting. So when we think about tapering, that discussion sometimes slides quickly into sort of itself being some form of tightening, and that is a little harder for me to immediately understand. Sorry, Pedro, I couldn't hear you.
I said the market tends to jump to that conclusion sometimes, right? I think that might be the issue, right? And therefore conditions might tighten in spite of whatever that intention might be.
Right, fair enough.
I also wonder how you think about just how you think about the transmission mechanism of QE, like what QE is doing, and the size of the balance sheet. Just initially, there was a kind of market stabilization aspect of it,
right?
And then there's a stimulative aspect to it. Could you talk about how you see QE as benefiting the economy now, and what pulling it away might do?
Yeah, I mean, I think in some sense I'm fairly conventional in my view. If you step back for a second, it's so much of this discussion is in some sense necessitated by considerations of the effective lower bound. That's kind of how we get here. This is not QE is not something that is utilized as a first line therapy, if you want to call it that, in settings where the funds rate could actually move. So, that's made drawing inferences about it, I think, more difficult in the sense that it's sort of brought out in duress situations. And I think given that the sort of the event study literature that I've been aware of, that I've been exposed to over the course of my career, you have term premia sorts of effects that are really kind of are important and ultimately helping this work, or add additional accommodation to what you can't do through just rates or just forward guidance, for instance. So in that sense, I have become persuaded that this is actually a positive. It is helping. I don't want to. I think as a research director, I don't feel like I can tell you exactly what the magnitude of those effects are. I think the literature is actually varied in its assessments, and I think all of you in this room are specialists for the most part, so you can look and see that literature kind of reaching varying conclusions. I think in some sense one doesn't need at the zero lower bound to have it be the most effective tool in the world. It still is something that you probably want to deploy as long as you feel like you can contain any downsides that it might have. And I think that's seems to have been the case. So let me leave it at that.
Fair enough. If I could just ask one more, which is I'd be remiss not to ask, which is
Sure.
when you talk about QE in any public forum and you ask people about it, you just get you get a lot of ranting about like this is just pumping up asset prices and benefiting the rich and kind of worsening inequality. Could you talk about the balance of risks as far as like how low rates generally in QE in addition might help versus hurt inequality?
So that's an excellent question. It's so good, in fact, that I won't be able to give you a good answer. I will do my best though. So I think there are a couple of trade-offs. One of them is really posing what the appropriate counterfactual is. So let's think about a situation where, like we are right now, the economy hopefully recovering quickly from a really bad real side event. All right, so your options now are not the luxurious ones of helping everybody all the time. Right now, the idea is let's get employment and have policy in a place where the maximum employment mandate has the best chance of being met. That is seen, at least certainly in the committee's actions, as being done best through a policy of rate setting that really is accommodative for a good long time, and that one that is aimed at making sure that the recovery on the employment side it has had a lot of room to run. So in some sense, the low rates that are in place right now are every bit aimed at making sure that the recovery reaches parts of the economy and individuals in it that often are the last to be brought in, are the first to be sent out in the event of a recession. So for me, if I'm rank ordering, that looks very first order in terms of inequality. If in the way you phrase the question, how does it matter for inequality? Well, I think there would be a first order effect on inequality moving up in an event where the rate setting did not prioritize just sheer economic recovery at the macro level. And I think that happens through low rate setting. Now, on the flip side, does it have collateral effects in terms of changing asset prices? Yeah, and the answer is, I think it has to. Any asset is, at least in an economist way of looking at it, is some discounted present value. And now we're discounting by a very tiny number relative to what we might have been doing in normal times. So very mechanically, that puts upward pressure on asset prices. That then, forces you to ask, well, where are the assets held? Who holds them? So it is certainly the case that in the US, the bulk of the population has relatively low financial asset holdings. Most people's asset holdings, in fact, really amount to the equity in their home plus some capitalized value of the Social Security benefits that they can get in retirement. Those are not big numbers. There's a much, much smaller group that, of course, owns an enormous share of overall assets, and so they would benefit from this. So I do think that the sort of, if you frame it this way, the right horse race is sort of not between sort of, helping the rich versus helping the poor, but in some sense, in my mind, in a very direct sense, to deal with the employment mandate, you might have to accept that those who are holding assets, who are long in particular kinds of assets, will actually benefit from that. And I think that that's something that is a trade-off that the committee always wrestles with, but that's how I frame it. Sorry for the long answer.
No, that's great. Thank you so much. I appreciate that. I wanted to drill a little bit more into how you're thinking about inflation. And I think one of the factors, in my own surprise and in exploring why markets were suddenly, freaking out about inflation, and even not just markets, but sort of centrist economists who shall not be named, worried about inflation. Of course, I think one of the big factors is the fact that we went from monetary policy being the so-called only game in town to fiscal policy actually coming into play. So I'm wondering how you're factoring fiscal policy into your forecasts, and how you see how you measure the inflationary impulse from the budget and from those kinds of pressures.
Yeah. So I'll take the prerogative of being a research director to speak from the research point of view for a second without wanting to talk too much about policy yet. So it is true that and I think Christian Mattis made this point in an article that you wrote, Pedro, that it is true that inflation has monetary and fiscal components to it in general. If one were to write down models of the price level and its movement, you would be able to connect fiscal and monetary policy together. They cannot be so cleanly separated. And I think Christian had this in mind yesterday or yesterday before, whenever you talked to him in thinking about inflation. So you're right to ask how they're related. In principle, in economist theories, they are related. That said, I think within limits, they are not so related in the sense that the Fed or the nation's central bank, I think, does and ought to see itself as being completely central in determining inflation over, let's say, the next 3 to 5 years. Now, if you spent time in places in the world that have extreme fiscal policies that come to be understood to be utterly unsustainable, just obviously patently unsustainable, those are instances in which inflation can move in ways that the central bank can do nothing about. Now, that's, I think, extremely far from anything that is germane for the United States. Maybe there are people in your audience or you that will push back on that, but as a premise, I would say, no, this is something that the central bank very much has control over. So then the question is, to now take your question and say, okay, a tremendous amount of fiscal support has been enacted and will find its way and is finding its way into household balance sheets and elsewhere. So that'll change. Let's imagine for a second that changes consumption expenditures or planned consumption and investment expenditures. Well, how does it connect to inflation? In a couple of ways. One is that you might, in the near term, expect firms, just like we were talking about at the beginning of this, in response to a change in the real growth prospects of the economy, thinking about their pricing. What will have to happen there? A couple of things. One is that if the change in sort of the demand that is being experienced by firms, imagine travel and hospitality and other sectors in particular, is meeting worker productivity that isn't necessarily going up one for one. And in fact, there's reason to think that it won't, simply because we're bringing in lots more workers, if this all works well, that will then not push you in the direction of having much higher marginal productivity of labor that would offset other prices. So in the end, I think that it's important to take into account what the Fed is going to do in the longer run. I don't think there's any reason to think that the central bank will lose control of inflation. The policy that's in place right now is very clearly, cognizant of what's happening on the fiscal side. So that hasn't been a surprise. So for that reason, I don't think that the transmission from just because something happened on the fiscal side to now something is going to happen on the inflation side is remotely obvious. In fact, it doesn't change my sense of inflation going forward, simply because I think that policy will be in the right place to handle that. In very short windows, you can imagine price level movements that would happen over the next, say, 3-6 months, or maybe even 9 months or something, where that would reflect real side changes in consumption, where the production side maybe hasn't caught up. Now, even that having been said, let's remember again the 9.5 or 10 million strong labor force that has kind of been marginalized. Add to that groups that have been sidelined at doing other things, including making sure that their families work properly and not being able to work in the absence of daycare and so on. There's room on that side too. So it's sort of fiscal support meets an economy that is very far away from anything like capacity, if you want to think of it that way, meets a monetary policy authority cognizant of said fiscal support. So for these reasons, I think that yes, you're going to have real pressure, but at the same time, I don't think that threatens inflation.
Fair enough. I actually saw one stat that took me back in the journal. I think about 1.5 million 55 and over workers have dropped out. That's pretty stunning statistic. Still hopefully in the highly productive phase of their lives.
No, I just very quick. Yeah, I mean, I think that sort of, that is to the extent that those departures are permanent. I mean, yeah, that's really a loss, no question about it.
We have a question from one of our viewers that's relevant to what we were just discussing, which is essentially what your model is for inflation now that the Phillips curve is dead. What have you replaced it with, and how have you resolved that puzzle, if you will, in your own?
Yeah, I mean, let me not at all speak for policymakers here. So I'll answer the question in terms of how I think about inflation, and my view is in some sense fairly orthodox, but it doesn't involve a Phillips curve that one can treat very easily as a menu to do anything with. So this is going to sound very normal, I think, if you've talked to people like me, because people like me say things like I'm about to say, which is, expectations are important. The central bank. So imagine a world in which inflation, monetary policy were conducted in a way that was fairly tightly linked to the underlying notion of an R star, or a flex price real interest rate that we like to track. Well, that's a world in which, if done perfectly, of course this cannot be done perfectly, but if done perfectly, it would be a world in which inflation might never move, real activity might move all over the place in response to real things that are happening to the economy, such as coronavirus. And so, you wouldn't really have a meaningful Phillips curve in that world either. Your questioner might, I think, would agree with me that that's a world in which the data would indicate a dead Phillips curve also. So I tend to think of the Phillips curve in some sense as this, I don't want to use this terminology. I'm trying to find the best terminology. So I tend to think of it as an object that is a relationship that one will observe in the data, but that is not some primitive deep feature of the data to be utilized for particular ends. Now, I think it's important to acknowledge that that's not where everybody is. And I think the reason everybody's not in that same spot is because there are good reasons to not necessarily sign on to this particular view of inflation. It doesn't fit all of the data perfectly or anything like that. So I think there's scientific uncertainty there that I would be remiss in not pointing out. So, for me, when I think about the Phillips curve, I think of it as something that emerges because of the way that policy interacts with the real economy, and not otherwise. So maybe you want to follow up, Pedro, because I don't know that I answered the person's question well.
No, that's really helpful. But I want to ask you more about expectations and what your favorite indicators are and such things. But expectations is an especially fascinating concept because it seems it's like self-reinforcing, but there's also different measures. So I wanted to ask you, one, do you favor consumer-based measures or market-based measures? How do you kind of bring them together? But secondly, kind of a more philosophical question, because we've had low inflation and low inflation expectations for a long time. People even talk about a generation of traders that's never seen inflation.
I see.
How they traded.
Yeah.
How would we ever get inflation expectations up if nobody remembers it?
That's a really interesting question. So let me take the first question about measures. I think, I've learned over my career not to get, despite what I just said about sort of, using a model to think about things. I think it's important to be more eclectic. The world is a complicated place, and so, I don't think it's just market measures. I don't think it's just consumer-based measures. It is known, of course, that the consumer side measures have certain kinds of biases in them, like the Michigan survey and so on. And, as an economist, it's hard for me to look past market measures simply because somebody somewhere has got money on this, and that has to focus attention. So, I tend to look at market measures. Now, those are not always squeaky clean calculations to make because they have other things embedded in them. So TIPS, for example, is not just inflation it cannot be read off so trivially. And there are going to be people in your audience that think about this for a living. So, I don't want to talk out of school too much on this, but I definitely think that's not the most trivial exercise. One has to take a view on risks and so on that are there, other premia that are embedded in them. Term structure models have some of the same kind of features. So in the sense that the market measures themselves have to be filtered through some theory in order to extract inference on inflation. So on the one hand, you've got, the discipline of the market. On the other hand, you've got some theorizing that you have to do to get a signal from it. So I don't think that's a perfect solution either. So in the end, you look at a sort of broad palette, and then you reach conclusions. I mentioned this inflation risk earlier today. So you ask people like John Cochrane, for example, who will look at options-based information on inflation risk. So I think you have to kind of keep all this stuff in your head at the same time. I do, on balance, I think, put stock in the market-based side of things. Now, on the philosophical question that you asked, that's a super interesting question. I think it really, maybe one immediate reaction is that it boils down to the extent to which one thinks people are forward-looking rather than backward-looking. Now, implicit in the way you framed it was the idea that one needs to see certain kinds of data in order for those data to be regarded as possibilities in their world. This is me putting some words in your mouth possibly, but hopefully it sounds about right. One point in favor of that view is that the Phillips curve that I described, sort of this modern rational expectations type of Phillips curve, it kind of has a harder time because of the inertia of inflation, which goes to the heart of your question, which is this thing has been, it's not just been, a little bit under where it was targeted, it's also been there for a really long time, and it doesn't move that quickly. So there are these inertial forces that seem present. One way to get or understand inertial forces in inflation is to think about an economy in which there are things that have indexation that are a little bit backward looking in them. I don't mean pejoratively, I just mean literally. They look back and say, what's been the experience? What ought to be the indexation that we think about going forward? That carries a residue, which makes inflation sluggish and not move very fast. So now, I've made the argument that people look back, to your point, okay? So the flip side is that people also look forward. So if you think about, and I'll go to an extreme for a second just to make a point, not because I think this is remotely germane right now. One of the papers that we learn in school it's a book, I think, by Thomas Sargent that really talks about the end of 4 big hyperinflations. Now I'm talking about hyperinflations now, so don't immediately connect it. I'm trying to make a point, and the point is that in those instances, hyperinflations were actually ended very, very, very quickly because of really serious, credible reforms. In those cases, on the fiscal side, going back to something I said at the beginning. And so there is room for policy to say, no, well, whatever the way the world was, here's what it's going to look like going forward. And then people are smart. and then they'll say, okay, I get it. This is where we're headed. So on the one hand, I think inflation is sluggish. It has been. On the other hand, I don't think that immunizes it to being baked in forever in the face of resolute policy aimed at normalizing inflation expectations. So again, apologies for that very long answer.
But then, like in contrast to the hyperinflation, I guess it would take some break in our institutional structure where policymakers throw up in their hands and say, "Hey, we're shooting for the sky as far as inflation," and that might be the trigger that actually unanchors inflation.
Yeah, I mean, even then, I think it would have to be something that people, market participants in particular, households, firms generally, came to believe was absolutely something that could go down. I don't, obviously, I'm not aware in personal experience of what the 70s, I was a little kid then, but, if you'd asked people then, could this go on forever? I don't know what they would have said. I mean, probably not. I mean, eventually there was will to kind of get rid of inflation, and it was gotten rid of for the next 30 odd years.
Yeah. When people try to gauge the strength of the recovery, there's a lot of emphasis on the savings rate, like this pent up savings. And it's a little bit, I feel like the discussion becomes a little bit callous when you talk about this pent up savings, especially in the context of how unequally distributed the pain of the pandemic was, right?
Right.
Yeah. So yeah, some people have accrued a lot of savings. Some people have gotten some relief from very, very tough situations. A lot of people actually died. So how do you look at the savings rate, how it's likely to be drawn down, and how people are likely, we were talking about behaviors going back to normal post-recovery, but I wonder if savings is one place where there might be room for kind of a reassessment if people are newly cautious about the potential for future disruptions like a new COVID or a new variant or something like that. Do people become more risk averse in the wake of something as dramatic as a global pandemic? How are you looking at that?
So that's a rich question. Let's first think about, as you said, the distribution of that savings. It is not equal. It's much of it is in the hands of groups that fared fairly well through this process. In some sense, it's why I said at the beginning that you can think of this event as being one in which a sudden, very large tax was placed on certain kinds of consumption. So that kind of consumption just didn't happen for a group of people. Who is that? That often tends to be the relatively better off, going on vacations, eating lots of restaurant meals, consuming other kinds of services, and so on. So they piled up savings because there just wasn't, much else to do with it. Those who have been lucky enough to retain employment through this whole period, I think really faced a struggle for, what is it that I'm going to spend my money on right now? Who am I going to spend it with? Communal consumption, you need people to do this stuff with too. So all these things worked in basically in reverse and kept a bunch of people from spending. Meanwhile, as you pointed out, there's a group of people that were just scraping by, for which the support on the fiscal side was swift and significant. So I don't want to minimize kind of the response that we actually as a society were able to muster on the fiscal side. But I do think going forward, whose savings will be kind of meaningfully altered by the scarring experience of this? Well, I think it'll tend to be, some people kind of in the middle, because what ends up happening is that there's a large group of people that essentially have no assets in the US. So if you look just for a second, if you zoom out at the life cycle, people's spending tends to track their income very, very closely until maybe age 40 or so. And they keep just a thin sliver of savings. That's the modal experience of the US household until maybe about age 40 or a little 45 perhaps. And it varies a little bit across different lifetime income groups, like high school educated, college educated, but it's kind of similar for all three. Then around 45 or 50, what we end up seeing is that people's spending habits look much closer to kind of orthodox economics, sort of textbook economic theory in terms of annuitizing the incomes that they have into letting consumption dribble out bit by bit by bit. So now if you've got a bunch of people that are kind of, if you've got the people that are doing well and that have wealth, by the time they're in the mid-life cycle, I don't expect them to kind of let that savings out in one fell swoop and run it all down very quickly. That would, to my mind, be counter to what we know about consumption savings patterns over the life cycle. So that means that in some ways, that's the good news, is that this will probably provide a very sustained smoothing of consumption spending by the relatively better off over the next few years. That's helpful for the aggregate economy simply because the better off do most of the consuming in the economy. On top of having most of the income and having most of the wealth, they account for most of the consumption. So that kind of augurs for a more stable path for consumption in the future. Now, I think there is something about the depression, I think, was studied. I'm at a loss to kind of report to you exactly what the consensus view was of when that happened, what happened to savings rates permanently. I think there have been mixed results. Some people find that this cohort kind of behaved permanently differently with savings, always worried about the shoe to drop. Others finding less of such an effect. So, I think, let me stop there and see if you have follow up.
No, that was perfect. And I wonder, as far as pent up demand, one of my favorite quotes from Chair Powell's testimony was, especially because, as you said, the sector that was, quote unquote, taxed by the pandemic was services. I think he said something to the effect of, a lot of people can go out to dinner, but you can only go out to dinner once a night. In other words, it's not like you're going to, go out and make up for the year's worth of,
absolutely.
dinners
No,
out.
I think that's a really important point. I mean, I'm glad that the chair made that point. I mean, just because that applies doubly to vacations. Like, some things take time as an input to produce. If you're producing the services of a vacation, which is how I would frame it, that takes two inputs. It takes money to get somewhere and stay there without being ejected. And two, it takes time. And, people that are doing well have a high value of time. And they're not going to allocate 6 months to a vacation just because they didn't get a vacation the previous year. So I have limited, optimism that sort of pent up demand will just simply power us through, rather than having it be a more sustained, solid kind of drip to keep us rolling. I think there is good news there for sure, but I don't think it's one and done.
I wanted to ask you, we talked a lot about inflation, and I guess that's what people are talking about, but I also wanted to talk about the other side of the mandate a little bit. And especially in the context of how you're looking at slack and employment, because, as Chair Powell has noted, while the official unemployment rate's at 6.2%, he looks at it as being effectively around 10% if you, account for people who have dropped out of the labor force and so on. So I'm just wondering how it's very unfortunate that we had a great experiment on full employment before this pandemic on how low we can push the unemployment rate without generating inflation. And I'm wondering how quickly you expect that we can get back to that, especially on the participation side.
Yeah, I mean, first, I actually very much, share the chair's overall view, and I think it's quite unreasonable not to, actually, in terms of thinking about all these, that the unemployment rate, if you really want to measure it, either U3 or add part-time for economic reasons, and then add, sort of the changes in the labor force participation. I mean, yeah, 10% sounds quite reasonable as a number that really is describing reality right now. And so there's a lot to think about in terms of getting things back. Now, how quickly can that come back? I think if, given what I said about the excess savings position of households and, just generally the fiscal transfers that have been made, maybe it's not inconceivable to get, to get to some numbers that are in the, sub 4 range, at some point. But I think, it's a little hard for me to think of sub 4 before next year. It's possible. So I think, you know, sub 4 for the headline number, which I think, you know, to your earlier point, would still not indicate to me that it's all done. You know, so I think you could even go further than that. You know, now on the other hand, I think in the most aggressive way of looking at this rebound, perhaps you get there much quicker. I mean, we did leave a period, you know, before this disaster of, I think we some in the 3.7 sort of range before things went very wrong. So there's no reason to think you couldn't get back to that if the skies really do clear. I think we're a ways away from that this year. You know, we were talking early just before we started today about risks, and we haven't talked that much about risks to the downside. And maybe this is a good place to bring that in, which is, you know, when I think about the unemployment rate or broad measures of employment for that matter, you know, I think I do worry about this summer and the path of the virus and variants coming back because we're sort of, I think we're running something like a horse race right now between vaccination and activity. And you know, I cannot tell you or your audience how I think that is going to exactly work out. So I think that if that happens,
had some scary. She talked about impending doom yesterday. I don't know if you saw her statement.
Yeah, I saw that. I can't say that I read exactly the reasons why she thought that, but yeah, so that's not comforting. I think, you know, but at the same time, I think it is still appropriately categorized as being in the realm of downside risks rather than sort of changing the way I think about you know, baseline real GDP, for example, where, you know, I think that a, you know, solid 6, maybe 7% number for 2021 still looks right to me. But should that unravel in the summer because of the virus, then I think the unemployment rate numbers, you know, could easily stay, the narrow numbers could stay above 5, the broad numbers could stay 7, 8, 9%, because again, it's going to be exactly in that eventuality. We have seen that movie once before. And in fact, I think the movie will run even worse the second time around, which is the groups that have had remote success with remote arrangements have had 1 full year to make the adjustments. We speaking for myself at our work, we are in a very different place now than we were a year ago in terms of how nimble we are. We're not the only people at all like this. So we have run an experiment. We've learned things also. So that puts a group that was already doing well in a more resilient position going forward, and it leaves the other group less resilient going forward. So I think that these broader measures of unemployment could actually be exposed down the road if you know, in these real events, almost worse than they were the first time, all else equal.
That's a good point. I wonder how you see the dynamics of housing evolving as well, because that's one sector where there's a funny dynamic there. There's on the one hand, you have downtrodden rental market. That's again, it speaks to the whole division. That's why I bring it up in the context of the job market.
Mm-hmm.
You have, and also in the context of how we measure inflation. So you have the downtrodden rental market, but house prices that have kind of been rising. But the way we measure inflation, there's the whole, you know, owner equivalent rent.
Imputed rent, yeah.
And so that means that there's a mix. And so I wonder how that factors into your thinking.
Yeah, no, I think it's right. I mean, just so for your listeners who aren't following this, I think you make an important point, which is, you know, what is inflation? It's the dollar price of a basket of stuff at different points in time. Well, what's in the basket? Housing is a huge part of the basket for most people. Problem is that owner-occupied housing doesn't have an automatic price. The housing service isn't priced every single month, so you can't get a read on that. So as Pedro, you pointed out, you instead go to looking at rental units and saying, what's the equivalent rental unit to this house? How many people have those? What's its price? And so on. So I think, you know, the devil certainly in some of the details of how those rental conversions are made. I don't want to comment too much on kind of the way that those are done. I think it's something we're watching. Now, I would say that, you know, go back to something I said earlier, which is, you talked about assets and inequality. Well, the low interest rate environment is one that is just going to mechanically, again, make housing, which is a very durable asset that throws off a stream of services to its occupant, worth more in present discounted value, even if you did nothing else to its real services. It's just more valuable because that present discounted flow is more valuable than it was before. So I don't know that right now inflation is somehow chronically mismeasured because of movements in house prices. I think there is an imputation that is made. I don't want to say that imputation is somehow drastically worse than it is at normal times, but it is something that we're paying attention to, and it's also something you generally pay attention, not necessarily from a policy action point of view, but at least as from an economics research point of view, you pay attention to movements in asset prices like housing, which are so important. And I think the reason I look at housing is just to kind of get a gauge for how people feel about their real futures too, because I think as it's a form of investment that I think also indicates a level of comfort with the near future, or even the moderate term future. So, I think there are these forces going in different directions on housing.
And then I wanted to go back to the framework, because you mentioned that in your opening remarks, and in the context of our debate about inequality, I feel like the framework shift was in part an acknowledgement of kind of U.S. social conditions, right? And also the experience of the last crisis, where we were able to run a fairly hot economy without inflation. But there are concerns that the inclusiveness of the Fed's employment goal might be difficult to achieve while keeping inflation expectations at bay. Could you speak to that potential tension? And what happens if inflation expectations take off while one particular group or another has not seen their unemployment rate recover, to its fullest extent?
Yeah, I mean, I think, one way that I think about this is it's certainly true that a lot of discussion happens, that it's premised along exactly the way you framed it, Pedro, which is if inflation expectations get away, then where does that leave you? For me, I think, a central bank over any window of time, must see itself as managing exactly those expectations. It is not something that necessarily, can just be taken as something that, it has a life entirely of its own, and so therefore it just one day, walks away from you, and then you have to react to it. So I think, it behooves me here, that to really talk about kind of the way that I feel like the committee and the chair have been so clear in their communications about what they're doing. The framework review, I feel like, was really important to my taste at saying, look, we own inflation. In fact, we own it so much that we're worried about underruns and we're worried about overruns, obviously. We're going to do policy going forward in a way that makes sure that we take into account that the proximity to the lower bound is appropriately adjusted for. That's going to allow us, that's going to lead us to act in certain ways that ultimately, cement where we think inflation ought to be. So in some sense, the framework review came out of not just what you mentioned, but also this real goal of cementing expectations. So against that backdrop, for me, it's harder for me to think about a scenario. It's not an impossibility, of course. It's, they could happen, but at the same time, it's very hard for me to think about a scenario in which, just because the labor market was thriving, that one ought to look and say, therefore now inflation ought to be high. I think there's an intermediate step there that says, how is the Fed thinking about, or the central bank more generally, thinking about the policy path against these two goals, especially noting that it is concerned about proximity to the lower bound in its rate setting and so on. So I think that has to show up in the filtering that somebody does when they look at, let's say, a low for long kind of a path before kind of the conclusion that, inflation is nigh, I think is not, to me, it's not really the right conclusion to actually take at all. That's a very Federal Reserve employee perspective, I suppose, but I don't think that the framework review came from nowhere.
Understood. Definitely. wanted to move our discussion a little bit to the international scene since we've stayed very domestic so far.
Yeah.
I just want to ask you about, and this is a global pandemic after all, and we're vaccinating. Countries are vaccinating at different rates, which leaves us with different rates of recovery. That raises all kinds of challenges. So, firstly, just wondering how you're looking at Europe's apparent inability to get its vaccination act together, and what a slow European recovery might mean for us.
So I think, yeah, I mean, that's certainly, should it turn out to be slow, I won't handicap it in terms of numbers necessarily, but I definitely think that's a headwind for us, and I think we need to watch it. More than anything, this goes back to something we were talking about earlier. Some of the experiences internationally make me not forget or lose track of downside risk. In moments when I feel most bullish about the United States in isolation, which I think there's a lot of reason to feel good about the US. I look and say, these are well-governed nation states that are having difficulty despite all kinds of, it's not that they're pathological places on the globe where one doesn't expect anything else. And so I do worry about the downside risk and then kind of seeing where we can go in terms of, so I think I put it more in the downside risk category rather than sort of imparting right now much of a drag to the base case of U.S. growth or employment. One other thing you could say is that on the international side, you can expect, in some sense, as the U.S. recovers, you can expect sort of, I think, that the trade deficit potentially to kind of grow, especially as the growth here is a little bit asynchronous with what you're seeing in Europe.
Yeah. And then with emerging markets, I've been kind of tracking Latin American central banks recently, and when the U.S. sneezes, the world catches a cold, whatever analogy you want. But the rise in yields here might seem mild, but it was sufficiently abrupt in Mexico to kind of prevent the central bank, which had been on an easing path, from cutting further, because basically market fears of inflation picked up, and so I wonder how much. So two things: A, what kind of market risks do emerging market disruptions pose? Of course, Brazil is tightening policy fairly abruptly. Turkey seems to be running into its own troubles. So what kind of risks do emerging markets pose to us potentially? And two, again, to your point about Europe, what kind of risks do they pose as far as an example as to what could go wrong with COVID?
Yeah, so I mean, starting with the second, I mean, I definitely think that Europe's experience is something that we should be watching to make sure that we are proactive and we can get through this vaccination program without having a significant second wave, or like now would be the third wave, I suppose. And so in that sense, that's the signal that I take from Europe. Going back to the first question, I think that the threats posed by emerging markets to the United States are very, I think they're not particularly, big. I worry much more in the sense that I think, as an economist, that and I think this is something that's not lost on the committee at all. The committee, really wants to make sure that it's engaged with the world central banking community, especially in emerging economies. And I think this is something that came out of the experiences of the last decade, where normalization in the United States proved to be connected to difficulties in emerging markets as they saw, funds move quickly. And I think in some ways, for me, for the Fed, it's really a question of making sure that set of communications is actually happening. And I think from what the chair and others have said, that is indeed the case, that we are engaged with the world central banking community to make sure that US normalization doesn't impart by itself real difficulties for emerging market economies, as we normalize, which I think now looks potentially like something that will be live as an issue, in the sense, if the base case in the US bears out, you've got a $20+ trillion economy growing at 6.5–7%. That is a monster in world terms. And so I think all the risks, to me, or the bulk of them, let's put it that way, kind of flow from our successes to potentially making sure that it's not destabilizing elsewhere than in the other direction. One of the bigger facts of trade economics that I recall, hopefully correctly, is that we do a lot of trading with like nations. We do much less trading with unlike nations. I mean, China to some extent is a bit of an outlier, but in some sense that immunizes us almost automatically from the travails of a bunch of emerging markets, but it doesn't immunize them against really good news here, because money can move.
Absolutely. And you mentioned global cooperation, and I wanted to close out our discussion by asking you a couple of questions about climate change, which is a subject that I know you've been paying close attention to. And
yes.
The Fed recently joined this green group of central banks that whose name I'll never remember.
Network for the Greening of the Financial System.
Thank you.
Yeah,
And
sure.
I wonder, and it's a hot button issue in a way, because it does get political blowback.
Yes.
You get certain rumblings on the Hill about this being beyond the Fed's remit.
Yep.
Even if it's obviously not affecting the conduct of monetary policy. But I just wonder how you're studying this issue, what you think the Fed's role is in it, and what you think we can expect.
Yeah, I mean, so I've made some public remarks on this, and let me just draw on them for a second. When I think about climate, and in the running of a research department at a Fed, I've had to think about exactly what you're saying. Like, what is my lane? What is appropriate for me to talk about on this issue? There are two things that make it important for me to have some assessment of how climate matters. One is that it is a macroeconomic phenomenon. If there ever was such a thing, it is climate. So I think it behooves central bankers to think about what change in the climate might do to the structure of the economy, to the decisions that people make within it. That's just responsible central banking. I think it's important that as you do this, that you very much acknowledge that policies aimed at mitigating climate change, changing climate change, accelerating climate change, whatever you want to think of, those do not, I think, those are not places in which central bankers, I think, like me, certainly at a research department, have a lot to offer, in the sense that I do see it as my job to take as parametric the decisions of the political system as it relates to policies, but I absolutely see it as my job to have a grip on whatever policy stance exists on the real economy. I can't not have a sense of how this matters for the real economy. So for the staff that we have, they've been thinking about this through exactly that lens. So my colleague Tuan Phan has a paper that really talks about the growth effects of climate change. Well, of course, that's relevant for us because it matters. Even narrowly, it ultimately matters for one's view of our star, if you think of that as sort of a important ingredient in policymaking. So I think it matters for that reason. The second thing is that all Feds have community development responsibilities, and that immediately asks us to think about the set of risks and opportunities that are being confronted, that our low and moderate income communities are being confronted with. And so again, even if one is very careful to take the verdicts of the political system at face value, it is important to understand what this means for those groups that the Fed has also been asked to look at and think about and understand. So that's the perspective that I have on climate.
And I mean, climate change has there's an environmental justice component, right? There's like the pandemic. I think Chair Yellen, I'm still calling her Chair Yellen, just like Chair Powell, but Treasury Secretary Yellen mentioned this in her push for greater climate action by the Treasury, that the poor, both globally and domestically, the poor are those who bear the brunt of climate risks primarily. So.
I mean, the one thing I'll say is that I'm heartened to see the political system in general engaged with the issue, because it goes back to something you said about the only game in town, for example. Like, I think that's inherently an uncomfortable place for central bankers to be. I think we always would prefer, I don't want to speak for all of my colleagues, but I certainly would prefer that the political system grapple with an issue, come to a decision on it, and then say, okay, central bank, you guys do your job, but this is kind of how we've landed on this particular issue. So when I hear Treasury Secretary Yellen talking about it, I think that's I'm glad that conversation is happening between her, the Senate, Congress, and so on. That makes a ton of sense to me.
All right. Well, you've been generous with your time, and I appreciate it. And just want to thank everybody for tuning in. And thank you so much, Kartik, for your time. I appreciate it.
Thank you very much, Pedro. This is super interesting, and you made me think hard, so I appreciate it.
My pleasure completely. Okay. Thank you so much.
Take care.